The call came through just after midnight in Taipei. A senior executive at TSMC picked up the secure line and gave a quiet order: suspend all new U.S. shipments. Within hours, Bloomberg terminals across New York lit up red. The 10-year Treasury yield jumped from 4.11% to 4.27% as traders began unloading dollars at the fastest rate since the March banking turmoil. According to Bloomberg data published October 4th, foreign central banks dumped nearly $48 billion in U.S. Treasuries over 3 trading sessions, the sharpest weekly reduction of 2025. In Washington, officials scrambled to confirm what Reuters called the most significant non-compliance from a U.S. partner in the semiconductor war. Commerce Secretary Howard Lutnick's office released a brief statement at 2 a.m., insisting that the refusal threatens mutual security commitments. Behind closed doors, it was panic. The U.S. planned to repatriate half of Taiwan's chip production, an idea pushed personally by Lutnick and endorsed by President Trump, had just collapsed in public view. The shock spread faster than any currency intervention could contain. In Seoul, Samsung executives were called to an emergency meeting with South Korea's finance ministry after reports that Washington might extend the same production ultimatum to them. The Financial Times reported that at least 2 major Asian manufacturers are now reconsidering their U.S. contracts in light of political risk and cost inflation. By sunrise, traders noticed an unusual symmetry: semiconductor stocks were falling in New York, while gold was climbing in Shanghai. The Wall Street Journal noted that spot gold hit $3,900 an ounce, its highest price since records began, as investors fled dollar-denominated assets. IMF data from September 2025 showed that the dollar's share of global reserves had already dropped to 56.3%, its lowest since 1995. This new defiance risked accelerating that slide. Trump arrived in the Oval Office visibly irritated. Cameras caught him pacing, flanked by economic advisor Scott Bessent, who warned that a prolonged chip standoff could, trigger an uncontrolled reserve rotation. Bessent's own numbers, cited by the Wall Street Journal, showed that foreign holdings of U.S. Treasury bills had declined by $289 billion year to date, with China, Japan, and Belgium's central bank accounting for most of the exits. Meanwhile, Taiwan's Vice Premier Cheng Li-chiun doubled down on national television, saying, "Taiwan will not commit to shifting 50% of our semiconductor production to U.S. soil." The statement was later verified by Reuters on October 1st. Chung emphasized that production sovereignty was as vital as defense sovereignty. That single remark wiped $320 billion off combined market capitalization across major U.S. chip-dependent firms by closing bell, according to Bloomberg's end-of-day data. In Phoenix, construction at TSMC's Arizona fab halted for 12 hours as local contractors awaited federal direction. Costs had already ballooned. Morris Chang, TSMC's founder, told the Financial Times in an August interview that building chips in America was 50% more expensive and 30% slower than in Taiwan. The journal confirmed those numbers again this week, adding that labor turnover at the Arizona site was 5 times higher than equivalent Asian facilities. As the White House tried to downplay the standoff, markets saw something deeper. Bloomberg analysts pointed out that nearly 90% of all advanced AI chips originate from East Asia. If even a fraction of that supply is withheld, the U.S. technology sector faces material risk within months. NVIDIA's latest H20 chips, already restricted by U.S. export rules, are back-ordered through mid-2026. Any further tightening could send AI infrastructure costs soaring. In Frankfurt, European bond traders began noticing an unfamiliar pattern: simultaneous selling of U.S. treasuries and buying of Chinese sovereign debt. The yield gap between 10-year U.S. and Chinese bonds narrowed to 1.05 percentage points, its smallest in 14 years. The Financial Times described it as the first visible rotation from west to east safe assets. Halfway through the day, a deeper shock hit. The Commerce Department quietly confirmed to Reuters that it had revoked validated end-user status for TSMC's Nanjing facility, effectively freezing all American equipment exports to that plant. South Korea's Samsung and SK Hynix received similar warnings, which immediately sent their shares down 4% and 5% respectively. In one trading session, Asia's chip index lost $76 billion in market value. Then came the phone call that changed the tone entirely. An aide entered Trump's Situation Room and whispered, "They're selling dollars." Within minutes, Bloomberg's dollar liquidity tracker showed emerging market central banks cutting U.S. holdings at the fastest pace since the 2008 crisis. This wasn't supposed to happen. Not like this, and not yet. For decades, Washington believed the semiconductor alliance with East Asia insulated it from currency retaliation. Chips were physical, money was abstract. But tonight, the two have merged. When the chip supply fractures, the dollar follows. By evening in Tokyo, Japan's finance minister publicly questioned the logic of the United States tariffs. He told the Nikkei, later quoted by the Financial Times, that forcing allies into relocation undermined supply resilience and investor confidence. It was an extraordinary rebuke from a longtime United States ally. At the same hour, Bloomberg reported that United States Treasury auctions failed to clear their top range, forcing primary dealers to absorb excess issuance. The last time this happened was during the debt ceiling standoff of 2011. The failure underscored waning global appetite for dollar assets. Across the Pacific, China's Commerce Ministry seized the moment. In a statement released on October 5th, it announced export controls on rare earth compounds critical for chip fabrication, specifically gallium and germanium derivatives. The move mirrored restrictions first tested in 2023. According to customs data cited by Reuters, China still supplies over 90% of these materials worldwide. The result was immediate. United States electronics manufacturers warned of inventory disruptions within 3 weeks. Semiconductor Equipment and Materials International, a California-based industry group, estimated that each week of shortage would shave $1.7 billion off sector output. Inside Wall Street trading floors, an unthinkable question circulated. What if this refusal marks the start of selective default? Not on debt, but on supply. Goldman Sachs analysts told clients that semiconductors now represent the most geopolitically constrained commodity on Earth. Trump's advisors pressed him to act. Lutnick proposed a 100% tariff on all non-compliant chip imports, a plan Reuters confirmed was under draft review. Besant objected, arguing that retaliation would compound currency flight. But political optics prevailed. Late that night, Trump approved the measure. Asia's reaction was swift. Taiwan's dollar strengthened 2% against the US dollar. The Korean won surged 1.4%. These are small percentages, but, the symbolism was immense. Regional markets were betting against Washington's stability. Meanwhile, China's sovereign wealth fund reportedly purchased $5 billion in gold futures and $8 billion in euro bonds within 24 hours, according to Bloomberg, on October 5th. The rotation echoed moves seen before the 2008 meltdown, but this time, it wasn't fear of banking collapse. It was diversification away from a politicized currency. Back in Washington, the fallout deepened. The Federal Reserve's overnight funding facility recorded record high demand of $615 billion, a level unseen since the pandemic liquidity crunch. Besant publicly insisted the dollar remained the world's settlement backbone, but honestly, markets were unconvinced. The yield curve inverted again, signaling recession risk. At 10 a.m. New York time, Bloomberg TV aired a leaked Treasury memo titled Dollar Confidence Contingency Plan. It proposed accelerated bilateral swap lines with Canada, Japan, and the ECB to stabilize flows, an echo of the 2009 playbook. The same document admitted foreign reserve liquidation could continue for months. In Arizona, construction crews resumed partial work under new federal subsidies, but insiders told Reuters that contractors still hadn't been paid for prior delays. TSMC's U.S. subsidiary now faces an estimated $48 billion cost overrun and a 2-year delay, according to the Financial Times. In Seoul, Samsung executives briefed President Yoon Suk-yeol that continuing U.S. cooperation without predictable export rules was untenable. Reuters confirmed the account through senior officials on October 6th. The message to Washington was simple: stop moving the goalposts or lose your partners. Meanwhile, Bloomberg Economics released a report showing that global semiconductor trade volumes fell 11% quarter on quarter, the steepest contraction since 2001. The dollar sell-off was now directly linked to supply disruption. Trump's televised address that evening aimed to reassure investors. America will not be held hostage by foreign manufacturers, he declared. But, just minutes later, futures markets contradicted him. NASDAQ 100 futures dropped 2.3%. The DXY slid further. Treasury yields climbed another 8 basis points. At the IMF headquarters in Washington, staff circulated an internal note describing the U.S. situation as self-induced fragility. It warned that persistent trade coercion may trigger alternative reserve systems faster than expected. A senior IMF economist, quoted anonymously by the Wall Street Journal, said, "Every time America weaponizes access, others learn to live without it." Across the Atlantic, the ECB announced expanded dollar swap access to cushion European banks. The last time such a facility was used was during COVID. Market stress indicators rose across the board. Then came a single data point that turned caution into alarm. According to Treasury International Capital data released October 6th, foreign official holdings of U.S. debt fell below $7 trillion for the first time in 8 years. The symbolic breach confirmed that the dollar's safe haven narrative was fracturing. Late in the night, a final cable arrived from Singapore's central bank. It announced diversification of its reserves toward regional assets, including yuan and gold. It was small in volume, but huge in meaning, one of America's closest financial partners publicly reallocating. By dawn, the screens in New York displayed a rare convergence. Dollar down, oil up, semiconductors down, gold up, and Treasury yields climbing. Every metric pointed to an economy under siege, not by enemies, but by feedback loops of its own making. In Arizona, the TSMC construction lights flickered on again, but at half capacity. Workers told Reuters they'd been instructed to slow burn until further notice. The symbolism couldn't be clearer. The most advanced chip project on U.S. soil was now running on standby. No one could say whether this was the first step toward decoupling or the last warning before it. But as the dollar's slide deepened and Washington's calls went unanswered, one thought began circulating among analysts worldwide. If America can't secure its chips, how long before it can't secure its currency? We're glad you're enjoying this video. Please like and subscribe. Check out another video that is now on your screen.